Okay, looks like it's summer. Not particularly sure if there's many people out there. You never know. Some stragglers might roll in. Is there anybody there? So obviously I've been away, what's up midweek, and we'll run through a few of the things that I think are important. You've got to preview the charts in that, everything up. Reviewed well what people are thinking out there. It's flip-flop between 25 bits and 50. All and the chatter as after the 52, throw all the data up in the air. Right, we'll which the Fed with when Armageddon, blow up, recession, super behind the curve territory. If they don't do anything in September, I'll run through a few things in a minute that are up there on the screen in terms of issues. Volatility obviously went through the roof on the 5th of August, and that by itself has issues. Just lost power to my mouse. And people trade volatility just like they trade prices. So when they hit certain levels, if they get too high, they just have to exit. And then if they go back into the low range, which we'll talk about, the 0.5 to 1% range, on the, let's say on the VIX, that means a VIX of 16 and below, and people are comfortable in investing in that environment. So it doesn't really matter whether they have locked in losses on the exit and getting back in. It's the backdrop that counts. It's whether the volatility is going to blow them up or whether it's a safer environment. And these are quant funds with huge inputs, and that makes a big difference. And they're playing longer time frames, but literally will exit and enter very quickly on the backdrop of volatility. So why do I say a VIX of 16? I've explained this before, but volatility measures through the VIX, that's an annualized number. If you want to get back to a daily volatility, then you need to square root it by, because that volatility is a squared number. To get it back to a normalized single day number, you need to square root it by the number of trading days in a year. So there's roughly around 250. What's the closest square number to 250? 256, which is 16 squared. So the market generally divides the VIX by 16 to tell you what the daily volatility is, plus or minus whatever. So when it's 16 and below, then the VIX is below. Let's have it. You're not audible. Hello, Raman Kumar. I'll just check whether we've got. Enough volume coming through. Right, hopefully that should be better. You're right. Hello, Vivek. Nice to see you. Is that better, Raman Kumar? Excellent. Thank you. So yeah, just literally talking about how to get a VIX number, an implied vol number, which is annualized, into a daily number. You divide it by 16, which is the square root of 256 trading days. So that's a lot of what's been going on since the carry trade, and the VIX jumped up to the 60s first time since COVID and the GFC, etc. That just automatically made people sell. We said that they'd be buying if it came back into that trading range, which we'll have a look at again later, but it is back in the channel. So it's off to races. So Nikkei, Nasdaq, SPX. We talked a lot about seasonality, whether the first 2 weeks of August are a negative. Well, we said it's since 1928 on average has been one of the lowest performers of the year, but generally ekes out a small gain. At the moment, the Nasdaq is just about flat for the 2 week period, and the S&P is slightly up. So it's
despite all the volatility we've had, we're almost sticking to the normal plan. Seasonality at its best. And we'll have a look through a couple of those for just how much they've moved and whether we're actually moving into the hoped for proper breakout, eking out top. So I mentioned it in one of my updates this week that some of the bearish community, the ones that have been calling for it's the end of the world, etc., have now allowed for the fact that it might be in the sort of 2007-8 territory in terms of the duration and playing out the mirroring of the actual moves, but also the fact that that allows for one more all-time high before we go into a decent pullback, if not in their eyes, a great one. Well, that sort of fits again. We'll talk through some of the underlying issues in a minute, but we've also got that NVIDIA result to come through at the end of 2 weeks' time, at the end of the month. That could just spur it into that eking out at that top before we top out. Is there any account giveaway in this live? Not at the moment, trader. So I'm sorry if that disappoints you. Go and ask Alex for one. So yeah, so money from influence from quants, and then we'll have a look at a chart that was on Bloomberg today, which is very useful. Commodity trading advisors, CTAs. Throughout that whole unwind, they've now ended up being back sort of flat bonds to equities, and therefore they're missing out on the rally. Again, they're another group that in low volatility will go back in. Because we've got recession fears, growth fading, growth is now back to being sort of chugging along. It could do with a little spurt. It's kind of, people are kind of building in the fact we're into a rate cutting cycle now. That does need to be delivered, but I don't think there's any need for the 50 bit blow up at the moment. All the negatives have come on the smaller side of the manufacturing services are turning around on the inflation side. The good bit of the CPI and PPI this week, and various reviews from retail sales and other things, is that the service elements where there were pockets of strength have all started to unwind, really. The only thing that is causing angst is the shelter side. In CPI this week, shelter jumped back to 4% month-on-month rise. They do use these rotating 6-month pairs of data, so it depends on which ones are being used in any particular month as to whether someone has rolled over their current rental agreement or they've done a new one, and there's a lot of lags in the scenario. Stripping that out, the super Atlanta Fed's measure of that sticky on a 3-month annualized basis, which is a good smoothing indicator that a lot of people like to use. They are below 3%, so they're back into the target range, and that is probably why Bostic, having looked at the data that his own Fed producers, couldn't any longer keep putting out this nonsense. So hence, from Wednesday saying we need more data to Thursday having an interview with the FT saying that we can't be late either way, and it's probably, I can see himself cutting in the September quarter, not waiting for Q4. So a complete jump. And he is one of the kind of leaders of the Hawks, so we may well see a few of those roll over in the next few weeks, and obviously going into Jackson Hole, where they'll all be aligned. So Jackson Hole Economic Symposium, Thursday to Saturday next week. We've also got DNC from Monday to Thursday, which is a Democratic National Conference. Talking heads politically and potentially on the Fed side. They'll probably save most of theirs for the actual meeting. It does seem constructive at the moment that the Hawks are just beginning to quieten down a little. Goolsby will be out again, the Super Dove at 1:30. He's made some decent comments this week, which we'll have a look at in a few minutes. So all in all, the dollar has started that consolidation that we were looking for. It's more or less at a 5-wave down. We had an option on whether to call the 5 waves or eke out another one. But either way, we said we've got a small consolidation coming, which we're probably halfway into. No real day today or Monday to get away. In fact, it's pretty quiet. Next week, a great week to go on holiday. Good week I will be doing. So apart from the big talking heads and stuff, there's a few CPIs and PMIs, but nothing really that should turn the dial massively. Entirely. So back to growth trumps everything. Important thing to notice if you haven't come across it, Walmart also reported US retail sales. They upgraded on their numbers, but mainly because high-income people are now going to Walmart as well as low-income, looking for bargains. So it just reinforces the whole. The economy is moving along, but it's fragile. People aren't taking prices anymore, so the prices are going to keep going over, and there's more and more people who are having to sort out the cost sides of things. Companies are talking about job losses, so the Fed really does have to start this whole idea in September. Whatever they do, they need to make sure that starts. They can just do 25 and say that they're still watching and they'll do it on a meeting by meeting, but to not start would be a disaster and would get forward the seasonal selling, which I don't think is going to happen. So again, looking at some of these stocks, we're now very close to the end of earnings season, particularly in the States. It has been a decent beat for the quarter, which we mentioned last week. 10% of companies are saying that their next quarter guidance is a little bit mixed, which is something we weren't expecting, but it hasn't derailed the fact that there will be sequential quarters growth for next quarter. So it is bobbing along quite nicely. It wasn't a disaster, and the whole AI mega overspending nonsense is being looked through now. It's every company that is bottom up AI, your sort of Palantirs, your ServiceNow, etc., and then mirrored in the Chinese online merchants, JD.com, Alibaba. They're all saying that the gains that they're seeing, efficiency gains from using AI to help companies, is delivering lots and lots of gains, along what we talked about. The input should be okay now. I've got it turned up. So Steve B, I don't know if that's a problem. I don't know. I have adjusted here for places where we've previously had a problem. You may have to adjust a few things your end. Has that made any difference for you? It might be your signal. I mean, we have had this problem before, but I've got the settings changed and I've got it turned right up there. The microphone input level is banging away at the top. Another thing is the bonds. Obviously, had a big rally. A lot of money was floating out of money market funds into longer duration bonds to take advantage of what potentially was big cuts. But hedge funds have now started selling December, which is obviously a clever bet. Rate cuts will start. If they're only at 25 basis points, then they won't have as big a duration effect, the gearing effect, into 3 months later than what they were first hoping for. So that's a clever way of locking in the gains that we've seen in the last few months. So net, I think we're back to chugging along with growth. The equities are obviously looking at that. They're happy. 50 bips and recession coming wasn't good for large cap stocks. Potentially wasn't good for small cap stocks either. Etc. Etc. I don't really know why the sound is breaking. If it is at your end, it should be okay. It may well be just a bit of overheating my end. I'm not sure. Cool. Yeah, it looks like on my Riverside, it just told me that there was a recording issue, so maybe that was what was causing the problem. So have you guys got any questions about things that you've seen in the last week or so? What assets have you been playing? Where do you think there's an anomaly? So obviously sterling data has come through okay. The GDP was in front of CPI this time. And normally what I've been following is the index of services in the UK, because when that is rampant, it tends to be mirrored in big gains in services inflation. Obviously, that started to retract in the last print, and again, coming through this week was a slowdown in the services side. They've been clever to get the first rate cut out of the way. Obviously, there was Taylor Swift read-throughs for June, which is coming back in August, which means the September print could be a bit choppy. But we're now aware of it. It shouldn't be a surprise. Hopefully that's factored in. I do think the underlying data for sterling leaves enough room that if the Fed cuts, the Bank of England just to stay in line can go if they want to. And now that they've established a 5-4 pattern with Bailey having the casting vote, then if that's what they wish, I think he'll be able to talk that through. And hopefully the kind of bobbing along nature of the UK data is enough to convince everyone. Again, the retail sales today, that was up in line. Retail sales in the States, that was a big jump because there was a computerized shutdown for auto settlements. There was a lot of pent up transactions that had to come back through the numbers, and that is most of what yesterday's jump was. So it was good that it wasn't a collapse, again, averting the big recession fears, but it isn't as strong as it looks on the face of it. It's just a good mid-range number, really. And I think the market reacted the way it did because of that. That was middle of the road, perfect scenarios you could hope to see. Oil's the one with a bit of strange data this week. The API private number was a massive drawdown, whereas EIA, the larger looked at survey, showed an inventory build. But within all that, the US have been rebuilding their special reserve, so that's probably what is bouncing around in there. Unlike the States, if you looked at today's retail sales in the UK, the measurement period had a pullback in petrol sold, whereas the actual price of petrol fell. So normally you would see volumes go up, people reacting. That kind of shows you how at the margin people are on spend at the minute. So are there any issues that you've got out there, the people that are listening? Do you think that we're just doing a dead cat bounce, a consolidation rally in indices, etc. It's going to roll over? And we'll have a look at gold again in a minute. That has obviously kept bobbing along in terms of physical buying without being as mental as it was at the start of the month. Every time there is a sort of non-inflationary print, the Fed's agents lean on it, try and cause big pullbacks where they just keep being mopped up. It's very dangerous to be selling gold from here to the end of the year because we're on the start of the seasonal patterns we talked about. We've got the Indian festivals coming up, we've got the BRICS currency unit coming, etc., etc. And September, October tend to be big periods. So just be careful what you do sell in terms of gold. Just feel like it just keeps nesting, ready for a breakout within the pattern we're in. Should have an all-time high again soon. Hello, MD Mustafa. Boom, 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 boom. UJ, that's obviously had a massive rally back. from what I was saying at the start, the volatility going back down to the low ranges, that's including on FX, etc., and the fact that the Bodge themselves have put a top into their policy for the minute. I see people put that trade back on. I said that people may well average into that, even with the likelihood that US rates are now going to be in that 25 basis point range. It does feel like we've had a bit of a technical bounce. We'll have a look at that one again. Still think it has the potential to get back and challenge that sort of 150, 152 level and then fade again. Good data from the US. Retail sales globally in general, China, Japan, UK, US, they're all decent numbers. There's a couple of issues there. That means in Japan, it helps them on their whole idea of trying to get this built-in wage price spiral. So they're beginning to see the record wage rises that have come through have started to be delivered in the last month or so. We're now starting to see larger spending. That will hopefully keep inflation going up. Then they'll ask for higher wages. The whole thing takes care of itself, spirals upwards, and it allows them to keep moving policy forward over the rest of the year and into next year, etc. So that's on track. The mix of the data in China this week, bit all over the place. Retail sales were okay, but loans were right on sort of almost flatline, massive pullback in the private sector loans. So that data is probably lagging the retail sales, or is in front, making retail sales be laggy. So next month there may well be a bit of pushback there. House prices, although they stopped falling, are still falling, and there are still a load of emergency measures to come from the People's Bank of China. And possibly some more rate cuts on Monday. So keep an eye on that. But China steel, amongst that, industrial production miss. They said it is a really harsh winter coming, and you'll see from iron ore prices, steel prices, copper not being ordered, etc. Anything to do with industrial metals in China is on the wane at the moment and not looking like it's turning anytime soon. Industrial production bobbing along at best. So that is not enough to get them to 5%, but they do need the consumer side of things to kick in. And remember, the only side of imports that jumped was them holding oil and semiconductors last week. So there isn't really much happening from the Chinese consumer en masse, despite the fact, I said JD.com and Alibaba are seeing good figures, but that might not necessarily be all domestic. Did I mention? I think I mentioned that. The underlying AI results, Alibaba, JD.com, they confirmed the trend we're seeing from the other side of it, Palantir, ServiceNow. They're helping companies change their processes. They're all making big efficiency gains for companies from the bottom up. So ignore this whole AI isn't getting monetized nonsense. It really is, and it's here to stay, and we'll get big breakouts. Even the semiconductors like Applied Materials last night, they were saying their Internet of Things semis, their market at large, their auto exposures, their fridges exposure, that kind of stuff. Demand is low there, but the AI side of things, the chip demand is obviously through the roof, just like it is for everyone else. So this has been a great opportunity for people to see a bit of an unwind, a lot thrown out, and then pick it up cheaply. What is probably also helping the squeeze is the number of leveraged products, 3 times, 2 times leveraged. There was a new one that came out last night, which is MicroStrategy. That is the Bitcoin proxy stock. That's got a 2 or 3 times leverage. ETF now announced, obviously NVIDIA, it's not volatile on its own, but that has, I think it's the biggest ETF in London, is now 3 times leveraged NVIDIA move. So not only does this hurt people when there's a crash, but the market makers are super short in a short space of time. So they have to end up squeezing the stock up to get it back in. It's sort of self-fulfilling to a certain extent. And there's lots more of that in there. So it's just going to make the ranges wider, which is why hopefully you've been reducing your stakes as you've been trading. to allow for this bigger volatility. Now the vol numbers are dropping off a little bit. It's probably safer to up those stakes. But keep an eye on the fact that it is still summer and that seasonally from the middle of September, equity markets normally roll. It's yet to be seen whether that's just going to be a pause in further upside or whether that will be a proper sell-off before we get into the, again, presidential year, buy through the election. So it's playing out as we expected so far, and keep your eyes peeled because there's lots going on all the time. And I don't know if we've discussed this before, you may know it, but lots of people in the hedge fund world and investment bank big hitters tend to go on long holidays in the summer. They hand over to some, certain experience, but junior members that don't necessarily have the limits in place, so they try and avoid trading as much as they can by widening their prices and making the sizes smaller. That just adds to the volatility and frustration of the market. The response generally is that people then go and trade in basket form, program trades, which puts the market makers en masse in difficult positions that they have to unwind, and that adds to some volatility. But that will all change when we get into September. And often these days you tend to see a little bit of underperformance in September because the big hitters are back and they go, what the hell, this is the wrong level. And they just give it a whack to see where we really are, just to test the waters. So any questions, or I'll just go on to just looking at a few charts and pictures that I've seen during the week that are interesting, some of which will be in next week's preview. No questions today. It's very, very strange. You're all boshing it, totally on top of everything. So if you saw the Bank of New Zealand this week cut 25 basis points, sort of unexpected because I think it's 2 meetings ago they were still considering whether they had to hike. Totally changed their outlook at the next meeting, and this week produced a cut of which they've said they're hoping to put another 2 in by the end of the year, and want to get down to I think they're at 5.25 now. They want to get to 3% by the mid of 2027 at the latest, and are happy to get there before if they can. But they are, which is interesting when you see today's data that came out. The PMIs were slightly higher than PPI. They just feel like they've got, I think, what is it, the third recession in 2 years is what they think they're on the verge of. So they're not messing around. They see trading data. They're acting like central bankers should. If it starts going the other way, then they'll stop that policy and put rates up. I just don't understand that logic that's been coming from Bostic, that we really can't cut rates just in case we have to put them up again. That is surely good risk management. It's total nonsense what they've been doing with the Fed. Should have started equalising a lot earlier. So if you do start to see slowing down in nominal, and that happens, nominal GDP talked about before, that is activity, quantity times prices. If prices are slowing, that quantity times prices by definition slows, which means nominal GDP slows. The relationship really is nominal GDP versus the Fed funds rate in terms of growth. So if that nominal GDP rate goes below what the Fed's fund rate is, they should be cutting to keep it in line. And we're right on the verge of that needing to happen right now. So hence, I don't think there's any way that they're going to get away from doing 25 basis points now. And then everyone can just relax and get on with it. Right, I just wanted to show you a couple of charts that will be in the preview. Obviously, buybacks. We mentioned it going into the season very quickly. The big buyback sport is at records in the US have been turned off, but look, since the end of July, that's been coming right back on. And as of now, 90% of S&P buybacks are here. Funnily enough, the market's going up. That just means that there's an order every day from the company itself to buy their own shares. So that tends to give a nice, backstop support for a lot of these heavyweight stocks every day. The one below that is really interesting. So throughout this whole period, commodity trading advisors, so hedge fund advisors, etc., futures advisors, their exposure to equity product went from almost trend highs for the last 4 years back to zero, almost zero, into this crash, and rotation starting in July, August. So it's highly likely that we've got the market moving up now in a low volatility environment. These guys need to own some equities, otherwise they're going to massively underperform. So that is quite indicative, I think, because it's unlikely that the update when this comes is going to go much more than a little bit of volatility either side of zero in terms of outflows. The place that is having big outflows is China, and that is causing them issues. It's making them have to try and support the currency, etc., etc. And FDI is out next week for China, fixed direct investment. So keep an eye on that, because if that is super negative, then you sometimes get little Asian wobbles on the back of it, because they're starting to mess around with the exchange rates. This was a great chart that they had in Bloomberg today, which is all talking about the vol control people. So people want to literally trade vol when it's shaded a bit up here, and they're largely exposed to market. As soon as it breaks down, which is volatility moving up as it did, then they instantly just dump. They're price agnostic, which is what I was talking about, which is when you've got the people either doing insurance for portfolios or actually their whole model relies on low vol. You get huge amounts of money taken out because these guys are only normally playing for sequential small gains. They don't want to walk into big losses. And that is this here is one of the primary reasons why AI is only at the beginning. Study finds 94% of business spreadsheets have got critical errors within them. I don't know if you've ever tried to do financial spreadsheet, but if you're ever getting circularities and stuff thrown at you, and a lot of them get ignored. So a lot of these processes go in and they do all the searching, create the macros, blah, blah, blah. Just clean up the data. It's the thing I talked about last week. Accenture, big part of their business is going in and cleaning up companies' data just so that it can then use AI. There's tons of people out there, by definition from this survey, that aren't even in a position to use AI yet. So this thing is only going one way. So this was the Nasdaq Kush on my chat. Was just talking. He'd been following it with the Ichimoku cloud, and would have the signal line show us into the start of August very negative. Obviously, we bounced off that low. We talked about this midweek on Wednesday. It was just beginning to challenge. Came back into the cloud. That starts to become quite bullish, particularly if it can clear the cloud. So we're right back in there. Having a little pause at the moment, but it certainly showed you it was an important level when we got to the edge of the cloud. Just like it was, that lined up with a 50% retrace for Nasdaq, which we mentioned, and it looked like a classic place where we might reverse. We're looking for a further advancement in that setup. I'll have a look at that now. So the move down started with the rotation on the 11th of July, really. It wasn't the 5th of August. That was just the ending point. So this is where we're touching the cloud when we're in this 50% zone here. We had a little bit of consolidation, and we've pushed on again past the 61.8 fib. It's really interesting what's going to happen from here now, because the substructure waves is the next stage to look at. So from the bottom to what looks like the wave on here. That's also currently gone above the 1.618. It's since we've just put in a little bit of a pullback in the last half an hour or so, which again sits with what a lot of people have been asking about, is why a lot of things do seem to be turning at the moment right on fib technicals, etc. I do think there's a lot of AI programming going on just for some basic program trading at a lot of these levels. It increasingly seems to happen, but in any case, within what I'm looking at, 1.618 becomes important, because that either is the extremity of the whole bounce back move, or if it's going to continue to extend, then we are in a real impulsive, and that is likely to become a 5-wave move up. Now, a zigzag, which is 5, 4x3, and a 5 as a consolidation, in those terms would likely take us to a new high, so it wouldn't be a consolidation. So it's pretty much like the odds would be it is the start of a proper breakout. Obviously, we need to get that new high in there, 20,700. Now, in the long-term waves that I've been looking at, and this is we're talking about a primary wave 5 to put in a cycle 1. This now fits with what I was talking about with the whole 3, 4, 5. I was saying I thought that this would turn out to be a 4th wave low. It did a double extension if you were following us a couple of weeks ago. But I think this is the 5th wave to eke out an all-time high, which again sits with what the super bears have now allowed for. So they think we've got this potential 2007-8 plan. They could spot that this was an extreme oversold scenario. Look how deep the MACD was. And when you got to see the reasoning for it, it was mainly on the super recession idea. Sorry, gremlins again today. It keeps telling me that it's there. Is that back? So since we had that, right, brilliant. So since we had the intermediate wave 5 and the primary wave 3 top over here, we went into that July the 11th pullback. We had a couple of options when we were halfway through what it ended up being. We said that connector might make the 4th wave ultimately throw itself out of the channel and then bounce. It really happened in a super cathartic way, big MACD fall. And the substructure, we had 5-wave move here for 1, that reversed, and then the current move up for what should be a 3rd wave is bang on 1.618 before it reversed half an hour ago. That may just be a pause before it carries on. I'm kind of feeling that there's more of a confluence up here with a double wave 1 move and a spot 786 pullback. There's a lot of selling pressure there as well. Previously halfway down, that's where the connector came in. The first connector came in, so it is an area of interest. So I feel like we're not going to come back too far before we put in what will be the first pause, and then we can put in a couple of percent potentially. But the way I see this going is that we wind ourselves up in 5 waves to this fifth wave sometime towards the middle of September, back to normal seasonality, which is what we're talking about, and then to cross that channel, its own channel there, you should come out the other side to put in the wave 2. Then just a normal, somewhere between 38 and 50% retracement takes us to 16,000. That will be seen as obviously a big sell-off if it happens. That is a 10 to 20%. That would be in line with a lot of the nonsense been happening in May. You can get some geopolitics coming back in, blah, blah, blah. That might line up completely with an early announcement on the unit, the BRICS settlement currency. But that's all postulated, but it just, and it doesn't necessarily have to be such a deep pullback. It may well just stay within that channel, stay into 18,000. It does open up because it's a higher degree wave that I look at. Once we get to the top of this channel, we have the possibility of a deep correction of some sort. And obviously, we can make an argument out of a lot of things why that could happen. But that would sit perfectly with the eking out the 345 that we were talking about and be rewarded for holding on. So Nasdaq, I think obviously that sits with a little pullback in the near term, consolidation before we probably have a big breakout on big NVIDIA beats. I think mood music suggests, even though they've got a small delay that the market knows about on the next super chip, everything underneath that is going gangbusters. All right, what we're left with. Hopefully the dollar is showing there. So to me, the dollar setup we were talking about previously, it's either put in the 5 waves to here or we're going to eke out another low. It feels pretty much like that's held. And the structure of this is mainly sets of small degree 3 waves. So I think we are in the consolidation, in which case this could double and go somewhere between 103.5 and 104. All that will happen here by measuring relative, what could be 1, 3, and 5. Remember, the middle one can't be the lowest. Currently, it isn't from that setup, so very easily, we originally had that as a 3. Make that now the 3rd wave. This is actually 4th wave. 5th wave moves across here, and we're in a 3 wave high degree consolidation. I said goes to 103.5, 4. Before that should resume further downside, because that will be a high degree 3 wave. And we'll see what comes to make that happen. That is obviously going to be going through the Jackson Hole talk at the end of next week. So that possibly sits a little bit of nervousness going into that. And then hopefully they open the door with some good language. So UJ, again, we talked numerous times about that having topped out, and it's done very similar to Nasdaq. It did end up doing a double correction. It's all about where are we now on the way back. So this pretty much looks like it's either a 4th wave here to put in 5th. We've got a lot of choppiness. Ultimately, I think this whole pattern will double from whatever pullback we get, which takes us into this sort of 150, 152 region. There's a lot of volatility. It's all about whether there is perceived strength in the dollar side of things, really. So is that going to come through from how next week builds? A little bit of dollar, just what you said on the DXY, a bit of dollar strength to top out. The yen is pretty much okay data-wise, even if they're not doing anything. And you've got people putting the carry trade back on because the volatility is through the floor. So it is still open to that happening. that would be pretty much a 50% retrace into there, which is something that we said that this would probably target before we ultimately end up going down to one sort of 128, 130 level would be an obvious stopping point for the whole move. But yeah, just be careful short term. I think there is the potential for another little bounce in UJ. Okay, so that's EU, which last time we spoke, we said, is that 3 swings there the actual wave 4? We need a new higher high to be able to prove that. Well, we've since had that, so this could well be the one in there. We're currently 3 swings down and what looks like potentially 3 up, so we've probably got another swing down, little 5 subwaves maybe to put in what will be a wave 2 pullback. Again, it all depends. I think the danger you've got with GU and EU is that they're both going to move. The central banks potentially want to move in line with the Fed. So whatever the Fed says this week, the Fed is talking about 25 basis points. I don't think the Bank of England or Euro particularly wants to go bigger than that, but that will open up the door to them trying to stay relatively in line, in which case after that we've potentially got more pullback in the Fed rates to come, certainly baked in by the market, so that the U can be loose. It fits with the DXY selling off, in which case we can get into wave 3 upside for GU and EU. But we just need to, in the first instance, find where the stopping point is, and that just on a simple equal legs basis from here. Puts us in the sort of 109 test again, really. So it's not got a million miles to go back, particularly if it's just a simple pullback, but in general, wave 2 can be a bit deeper. Often looking for, can end up being 60% of the whole move. So there's every chance that could end up doing a double, but a natural stopping point before we get a rally, whatever the weather, is sort of 109 level. So I'd have 109 in mind as a potential buy short term. Yep, so GU, we did have that bottom on the 11th, on the 8th, sorry. We've since been talking about holding the 50-day moving average, which in general it has done. And again, this should keep eking out new highs. We really want to see it take out that 130.5 level. So data-wise, the UK is going to go into a period where they know the data is against them, which is why they put the rate hike in. The market should react more positively. Long G versus shorter U, I think, is the primary setup, and then we'll just see how we react around Fed rates, etc. Again, it's a quiet week for data, apart from PMIs really, for the UK next week, just like it is in the States. CPI is Canada and Eurozone So all about Jackson Hole really. We may come back and test this 50-day moving average if we get that little DXY 1% move up, etc. But then we're looking for that to bounce off it again. So I did go through and redraw the DAX, what was previously still sort of going sideways and going nowhere. Ended up moving the 3 high across from here rather than being in an expanded flat. It makes more sense to have that with the 5-wave move as the minor wave 3. And then the rest of it does look like a load of sideways, as we talked about, movement with impulses in the right places in the C and Y, the C legs and of the Y legs. We haven't put in an expanded flat nature, so it is a flat, normal flat. The 3 lots of 3 wave swings, and obviously we had a capitulation, what very much looks like a 5-wave down there to put in that 4-wave 4 minor low, and we've since been bouncing there. It very much looks like we had the Nasdaq. We had this choppiness, which was a leading diagonal. We put in a 3-wave consolidation. We're somewhere in the minor wave 3 bounce. Looking at, we're going to have a little bit of choppiness, which should be topping out. A bit like the Nasdaq, we said, look, should get a pullback then to a couple of percent below where we are now. That will have the break of the 50-day moving average again, and we should reclaim it and go on. Hopefully, put a new all-time high in for that move alongside the Nasdaq. Obviously, the tech side of things is leading at the moment. There's a lot of industrials still in the DAX, which is why it's been stuck in that meandering sideways nonsense, really. They're in recession, they're in manufacturing, Maya, and those particular stocks, as we saw going through the setup. Sorry, I'm just distracted by gold going nuts. Just wondering what that is. Is that an all-time high? Anyway, that's a similar pattern to Nasdaq. I think they're all going to be driven by the S&P and Nasdaq at the moment. So yeah, just quickly over on gold, we've been talking about it being a 3, 4, 5. A lot of people have tried to call the top on this. I said I don't think it was there. We need to have this breakout to the top of the channel. The fib 2.618 for the wave 3, 25.50 and potentially above. Remember, we've still got it up there on the original minor 3 channel. So anywhere 25.50, 26.50, I think, before we get a proper pullback. We've been proven right so far in the way that this has pieced together. Obviously, we're through the yellow line. So this pretty much is nesting by the look of it. And this here was a 3-wave pullback, subwave. As we're going up, so even in the waves that we're in here, which is a 3rd wave, we've got a 1, a 2, quite possibly a 3 to there. We've got a 3-wave pullback 4, and now we should be putting in a 5-wave move, of which that looks like 1, 3-wave consolidation. This is the 3rd wave of 5. So wherever this stops, consolidates, and then puts in 1 more high at least, just for this degree of wave. And then because it's a 3rd wave, we've got a pullback, and then the final wave up, which should take us to those breakout highs. This looks, and has been for a number of weeks, like it's been driven by physical. Every time it's tried to sell off, it's getting held by orders coming in. you see those at 2 o'clock, half 1, 2 o'clock, CMI overnight delivery report, what's been going on there. A lot of this actually does take place in the real world, in the OTC, a lot of it on the Shanghai Physical Delivery Index. But whenever they go into the casino pit, where it's 96% paper filled, when that 4% asks for delivery, and if not a bigger percentage at times, then they're in all sorts of trouble because nobody wants to settle. It's a pain. And they've also got to find it. They've got to find a physical seller to meet it. So we keep getting these breakouts. This is in the pattern we're in March, where we just keep driving it on the physical delivery contracts. So ignore the real interest rates, ignore the geopolitics. They're all just on the side beneficiaries for gold. This is being driven, these moves, by physical and or naked shorts having to chase back because they're getting margined. And remember, one of the reasons why a lot of people don't want to deliver, in order to deliver, you have to be fully margined. So you've got to provide the money and find the gold. So it's a reason why speculators don't necessarily like to be involved in physical delivery, because they have to pay the money at the end of the day. So that's good news. We've been waiting for that. Let's hopefully that can carry on now and avoid getting one of these ridiculous lean-ons. What tended to happen in the move ups, the reason we get these spikes down, is that the physical does find a supplier, and then anyone that's been short and squeezed is trying to smash it down to either get delivered against physically for some future orders, or just to unwind their losses and or try and eke out a profit. And you also get on days when it's helpful for the Fed to get inflation perception down, that they're selling gold to buy dollars to try and support the whole complex. Anyway, it's played out as to how I've been describing it, so I'm quite happy with that. I did say there was another all-time high. There's a lot of people have called it here. I think we're going to upping out into 2200s. So we'll take that for now. And like I say, if the structure continues to be right, we've still got all this upside to expect short term for this as a proper consolidation. Yeah, so the other thing, you get sequential wave 3 highs. So you had a sub wave 3 here, another sub wave 3 here, and then by the time this finishes, that will be a 3. So when this original, which I think we're probably going to break this red channel to put in the red wave 3, when that eventually ends up being the higher degree 5, and that 3, then because that's quite an important one, there's every chance that that will actually be a new MACD high. So this MACD has got every chance of being the driver for us here, because this is going to, this 3 when it comes, should be over here now, is a minor wave 3. It's the one where a lot of the action is done. So that should be an important MACD print. And this is suggesting that there's lots of momentum still to come. You know, normally we get a slap in the face as soon as I say this, but it is still winding its way to plan. I hope that's helpful. Does anyone else have a view on gold? So I'll take that's a no. Right, I'll just run through a couple of other charts and then let you go on your merry way. So the S&P again, we're saying that 1.618 equal, when you're looking for the equal legs, that's the sort of bound for where it shouldn't get much bigger. If it does, then you're in a proper impulsive move down. The question is, are we doing what we talked about on the NASDAQ? Are we going to eke out a new high at the top of the channel trend range? Or is this just a dead cat bounce that ultimately falls away? So again, the MACD highs, there's no real divergence yet. So if we get a new high up here on a lower MACD peak, then that will tell us that we probably will be at a turning point. So keep an eye on this whole relationship here and the subway peaks. We'll try and keep you informed on that, but it does pretty much feel like there's another move up to come. Just while we're here, let's get the super messy chart out. Just want to highlight what we've been talking about before. And look, we did have loads more volume at the turning point. Is this the 200-day moving average, again, above and below the 50%? We did say that needed to have more of a trend, like over here when we were in a deep pullback. This very much looks like it was an instant pause, was no real follow through in the indices in terms of underneath structure being broken, and it's since continued up the 50-day, above the 50-day moving average. That again never moved up to there, so that is into 65% region again. You know, that is approaching where it normally wants to turn, is when it's in this sort of 75 to 90% above moving day, 50-day moving average. That's when we start to run out of room. But we're nowhere near there at the moment. We're only just starting out again on the ascent in terms of the trend channel. If you drew a trend channel through that, we're halfway. Again, suggests we've still got a bit more room to get overextended. We're not overextended in terms of the underlying structure of the S&P. The FTSE daily, we said we still haven't had that all-time high, so we still haven't, but we do feel like that was a cathartic finish, just like everything else, to put in a wave 4 for now. Obviously, if you don't believe in the breakout, you've got that high there as a stop loss. If we go above that, then we should really be looking at breakout territory. Again, that's your second price, the wave 3 high, 84.78 spot 3. We need to break. Obviously, above there, this can be valid at any point. But really, we're looking for it to eke something out over here, really, into the middle of September. But as always, this has been the kind of secondary index relative. This has very little tech in it. But it's in the same sort of plan. It's returned to positive momentum in the last, since we hit that super low, as you expect, we've bounced. But it's nowhere looking at for a wave 3 high. Subwave, you'd expect momentum to get up and challenge that. So it's all suggesting we've got a couple of weeks potential in a lot of these indices to top out. There's a lot of toing and throwing on oil. if it ever appears. We're in this idea that we're in an early structure part of wave 3 down. We thought this was a kind of decent spot for the fifth wave of lower degree to stop, in which case we go into a 3-wave swing. It looks a little bit more like 5 waves to start with, in which case that is a zigzag. So we're going to have a 3-wave consolidation. So there's potential for another 5 waves up into the low 80s before we turn back down again. We'll keep our eye on that. That's a valid interpretation at the moment. Obviously, we're in the main looking for its continued downside. So I don't want to fall in love with buying it, but maybe looking to short this in the low 80s might be the best play. And looking at probably 3 to 4 to 1 risk reward from that. Just to illustrate, at large, the bond index volatility, that's returned more or less back into its trend level. So we were looking for 105 to return. And then the VIX, as we talked about, ridiculous spike up, has returned back to where we were at the end of July, if not below. And this is the real chart we want to look at. Remember, GFC, COVID, and now yen carry unwind. But we were talking late last week saying that we want to see this come back into the channel. It was still sat above in the 30s, then into the high 20s. And now this week, look, we're right back in the trend channel from the market highs in late 21, early 22. So yeah, really, we want to see this just stop anywhere around the sort of flat line across here, 12 to 15. In here is perfect, but that will just be, as we said before, sequential 0.5 to 1% moves per day for the big. We do want to see keep returning money to the market alongside the company buybacks, strong fundamentals supported by the rate cut cycle starting, and net everything back to normal, just like it to be. So hopefully that's useful. Any questions at all? Thank you, Marisha Mibazart. Great name that I'll make to say. But hopefully you've all been surviving in amongst this. Volatility is now getting back towards normal. Those charts, a little bit hiding in the duvet, but you know it is still some of volumes, like I said, and price making is still a single kind of hole that it should be. So just be careful for the outlying moves. September onwards is when we want to go back to normal levels. But again, seasonality tells us that we might have a sell-off. So careful. I think you're cementing the move out. We might consolidate short term, but ultimately going to put in this new all-time high before we potentially have the decent sell-off. That would make our whole stance since April play out with the 3, 4, 5s. Anyone that's been following that with me for a few weeks. That is how we expect it to go. Didn't quite expect a double correction for the current wave 4, but so be it. At least we were aware of it. We might have been beaten up slightly in the second half of that, but we survived and come out the side. And gold is doing everything it says on the tin. So the things we've been focusing on have generally been playing. So UJ, just be careful. There's potential for a bit more rally, but the end game for that is still probably for strengthening yen. So just be aware. It's been great chatting to you, although I'd prefer some more questions, please, if you can next time. I'll do one more of these on Monday before I'm then away on holiday for 2 weeks from next Wednesday. So I'll try and cram as much stuff into the preview and Monday as possible. But in the meantime, good luck with the rest of today. Please give us a thumbs up if you can, a like on the video, and I hope to see you again on Monday. Thanks a lot.